Here's what's coming up on Strategic Wealth with Matt Dickett.
Once you get into retirement, or if you're close to retirement, now it's no longer about the big ups and the big downs in your portfolio. It's about getting consistent returns.
Okay, let's talk a little bit about our guide that we have, that we make available to anybody that wants to request it. It's something that's called the Guide to Finding the Right Advice Givers. Those that follow us here on the show know that we primarily work with individuals that are retired or soon to be retired. Okay, let's talk a little bit about our guide that we have, that we make available to anybody that wants to request it. And it's something that's called the Guide to Finding the Right Advice Givers. Those that follow us here on the show know that we primarily work with individuals that are retired or soon to be retired. That's probably a lot of the individuals that tune in, but we may have some younger folks or those that plan on working a little longer. So what are some tips that we usually talk about in the guide as far as what to look for in a financial planner or financial advisor, or whatever you want to refer to it as, whether it's someone you're working with currently or maybe if you're starting to look around or shop for somebody different?
Yeah, I think working with a financial advisor, unfortunately not all advisors are created equally, and they actually follow different rules. So we always think it's important to find a fiduciary that has the responsibility of only recommending things that are going to be in their client's best interest. Mm-hmm. So I think that's the very first thing that you need to look for.
Well, explain fiduciary, because that may not be a term that a lot of people are familiar with.
Yeah, so anytime you go get financial advice, there's going to be two different styles or two different types of advice you're going to get. Fiduciary means that they legally, morally, and ethically have to recommend only what's in the client's best interest. Mm-hmm. So they have to justify. Let's just say that something went wrong and they're in court and the judge says, well, why did you recommend this? Mm-hmm. They would have to give a reason that justifies why that was in their best interest.
But isn't that how all advisors have to operate, Jordan?
Unfortunately, no. A lot of brokers, if you look on the back of a business card, you'll know what kind of advisor it is. It'll either say investment advisor representative, which is a fiduciary like us, and then it'll say registered representative, which is a broker. And those are the people who have a fiduciary responsibility, but that's to the firms they work with instead of the clients.
Right.
Mm-hmm. And I think that's something that a lot of people don't realize, that there's a big difference between advisors. They probably just assume that everybody has to do what's in their client's best interest. We wish it was the case, but that's certainly not how it operates right now. It's one of the things that we talk about in the guide. Now, if someone requests the guide, what's maybe some of the other things that they're going to find, Jordan, that might be useful?
Well, kind of a risk assessment quiz. I think the first and the most important thing you need to do whenever you're looking for someone or deciding how you want your retirement to look is how much risk tolerance you're comfortable with. Inside the guide, we have a simple, maybe 20-question quiz to kind of help you get a better idea on how much risk you're comfortable with.
And the quiz is kind of fun, right? You get a score at the end. So yeah, you don't get a grade, so it's not a pass or a fail, but you get a score, so not as bad as taking a test in school or something like that. One of the things I mention all the time, Dustin, is that success leaves clues.
Yes, it does.
All right. This is maybe a little touchy area for some that are out there, but if you're looking for an advisor, I really think that you want to go to an advisor that has a proven track record of success. So what are some things you would recommend individuals look for?
Do other professionals go seek advice from this advisor? Do attorneys go talk to them for advice? Do they have a TV show? Do they have any books that they've written?
Or maybe a radio show.
Or a radio show.
TV show or radio
so,
show.
Success leaves clues. It's easy to find out whether or not who you're working with has a proven track record. Mm-hmm.
And I think it's also important to ask, what is their track record in working with someone that's in your specific situation? Mm-hmm. Meaning you don't necessarily want to go to an advisor that maybe works with individuals that like to pick the hot stock of the week, or maybe there are individuals that don't mind a whole lot of risk, and maybe they've got a lot of pension income, or maybe they own a lot of real estate rental property, and if they lose money in their IRA, it's really no big deal. So maybe they don't mind some risk. Well, there are advisors that could possibly do a very good job at that. But if you're someone that wants to have your money in a little less volatile type of position, something a little more consistent that you can count on, you should really ask them how successful they are at helping someone just like yourself. Mm-hmm. Because I think that most advisors, if you talk to them, they're all going to claim, oh yeah, we can help you, we'll be successful. But And that may be true, but I mean, is it the type of success that you're looking for?
Right.
You know, obviously maybe they can do some things that are really good for themselves or maybe really good for other types of investors, but maybe not necessarily for you and your particular stage of your life right now.
And on that subject, I would say majority of the time, the person that's helping you get into, through your working years and close to retirement is probably not going to be the same advisor that you should use into and throughout your retirement. Because it's a completely different strategy, it's a completely different set of tools that you're using to try to accomplish those goals.
And it's that scenario right there is really why we created this guide that we're making available to everybody, because it is a little confusing. You're not really sure who to go to and who to talk to. Now, I know, Jordan, one of the last sections that we have in the guide talks a little bit about what to expect if you were to, say, give us a call and request a complimentary consultation or a second opinion in the office. So we talk about that in the guide, and again, anybody can request it, but why don't you talk a little bit about what to expect? If someone listening right now has questions, they're not sure if who they're with right now is the right person or not, what happens when individuals come into the office?
Yeah, well, the first thing, it's just an opportunity to see if we as a firm can help or add any value. So, some firms you go to, maybe they're high pressure. We're obviously not like
because we can't always help, right?
Yeah,
I mean,
yeah,
sometimes individuals are in a good position, and if they like their advisor and they're happy with them, well, then they might not need us. So how do we determine that?
Yeah, well, really it's to see if their goals and what it is that they're wanting to do in and through retirement matches up with what we do as a firm. Like you said, we're not a perfect fit for everyone. Some people, their portfolios are already great. There might not be anything that we need to do in some circumstances.
Yeah, so just really a chance to get any questions that you might have answered for us to see if we can provide any value or not. Sometimes we can, and then other times we can't. So, well, great. Thanks, guys. If you would like to request a copy of the Consumer's Guide to Finding the Right Advice Givers, feel free to give us a call at the office, and or you can request one through our website.
When you have confidence in your retirement future, you can live the life you've always imagined. Because of planning, you now have time to reflect on the wonderful memories of your life. You and your spouse finally have the luxury of leisure time together. To spend fun times with your grandkids, sharing the joy of their excitement about life. Smiling at the thought of quality time with your children and of picking up the check. At last, you have time to breathe and rekindle the love of your life. Why? Because you imagined what could be. You planned for retirement. So today, you own your future. Imagine what's next. Plan today, own tomorrow. Call Strategic Wealth Designers, 502-412-3354.
I want to talk a little bit today about the importance of consistency in your portfolio. And once you get into retirement, or if you're close to retirement, now it's no longer about the big ups and the big downs in your portfolio. It's about getting consistent returns. You don't want a whole lot of excitement either way. So I want to take, for example, I've got a portfolio here that it's a $2 million portfolio. And what we're going to do is we're going to compare two accounts that both average the same but have very, very different results. So let's just say, for example, that we take our $2 million portfolio and we put $1 million of that into, for example, let's say Facebook stock. Okay, and then on the other $1 million, what we're going to do is we're going to put it into a balanced portfolio. And what this portfolio is designed to do is it may not gain as much as the market in the big years, but also we're not going to lose as much as the market does in the down years. We just want to have some consistency in there. So we start with the same $1 million in each portfolio. And in the Facebook portfolio, let's say that the market goes up the first year by 60%. So now we've turned that $1 million into $1.6 million. Okay, that's a pretty excited person, I would say, that has that portfolio to gain 60% in a year. And now, let's say in the other portfolio, in the balanced portfolio, that it goes up 30% that same year. So while Facebook was up 60, this portfolio here was only up 30%. So this original $1 million is now worth 1.3. Well, if those two people, if there was two different people and they saw each other at a party or something, the 60% portfolio, he'd be on fire. He would be very excited, I'd say, and the other person's not so excited now that they're seeing somebody else made much more than them. But now let's fast forward to the second year. With the Facebook portfolio, it lost significantly again. So now it's down 40%. So we lose $640,000. So we were up to 1.6. Now we've taken a 40% loss. So now we're back down to $960,000. So if we look at that, so it averaged, it's up 60, then down 40. It averaged 10% over those 2 years. Now, let's look at the other portfolio. So we were at 1.3 million after the 30% gain. This one goes down only 10%. So it did fall a little bit, but it was in a safer position. It's not going to be as drastic as the, let's say, Facebook stock. So now this 1.3 million lost $130,000. So now this original $1 million is now worth $1.17 million. It too averaged the same as the Facebook, so they both averaged 10%, but we have much, much different results. So we always want to really focus on getting consistent returns. We don't need a whole lot of huge gains as long as we never experience any of these huge losses. So this is just an example of how consistency really pays off over time. If you have any questions about how to make sure your portfolio is set up in a way that you're not experiencing these big losses when the market is going through the volatile years, please feel free to call our office and or visit our website.
Thanks again for tuning in to today's show. I have to tell you, Dustin and I have been receiving more calls than normal lately from folks like you because people are concerned with what's happening lately in the stock market. They've simply heard from their stockbrokers to stay the course, don't be concerned, but we're definitely seeing a reason to get a second opinion. Now, a lot of that, it comes down to having a plan.
Yeah, unfortunately, we've seen a majority of cases lately that people have done a great job saving for retirement, but they and their advisor don't really have a plan as to how to structure their portfolio in retirement.
Yeah, and this is especially the case when it comes down to structuring their portfolio for income. Studies today show that if you remain in the typical balanced portfolio, the appropriate withdrawal rate is 2.7%. So if you had $1 million, that's only $27,000 per year that you should be drawing in retirement. That just seems crazy.
Yeah. When we're structuring a portfolio during retirement, you're looking at closer to 5 or 6% withdrawals throughout retirement. That's why we encourage you to give us a call for a complete retirement review.
Yeah, we can take a look at your current portfolio structure and let you know what kind of yield you're accruing, let you know what kind of risk you're taking, and much, much more.
We'll spend some time talking to you about how to appropriately structure a portfolio during your retirement to generate an income where you don't have to lose sleep when the market isn't cooperating.
We also can't stress tax planning enough. A majority of people who have saved for retirement have their assets in retirement plans such as IRAs, 401ks, and etc. And guess what? During retirement, these are your most highly taxed assets. So we feel that it is our responsibility for our clients to find the best strategies to withdraw those funds at the lowest possible rate, or when the right opportunity rises, to shift those funds over to a tax-free asset. So again, we welcome you to give us a call for a free, no-obligation visit for your complete retirement review. We look forward to sitting down with you soon.
On this segment of Strategic Wealth University, we're going to be looking at a couple of commonly used financial terms, but rarely ever explained simply. These terms are long and short. Now, what do I mean by long or short? Long means that an investor has ownership in the underlying stock and anticipates that the stock will rise in value. You'll commonly hear the term long on equities, right? So for example, Jim holds 30 shares of company ABC. He's long on equities because he is, for one, holding a stock which is an equity, and he's long because he maintains an ownership interest in the underlying stock. Now on the other side, we have short. There is a lot of talk about shorting, short selling, or being short, and I really want to build a foundation for this. I think that it's often misunderstood and in some circumstances shorting can yield good returns. Now, to short something, it really means you owe the underlying investment at a certain price in the future. I like to explain it as making an investment with the expectation or belief that the underlying investment is going to decrease in value in the long term. Now, when can this be appropriate? Sometimes this can be appropriate when an investor sees a sector of the market where there's an overvaluation, and the investor sees that the investment has a high probability of going down in value. So, for example, let's say Dave evaluates company ABC, and he sees that it's trading above its true value, or what he believes its true value is worth, and he really feels that it's going to go down in value. So he shorts company ABC, and he can make money as the stock goes down in value, or make money on the downside. So a lot of investors will short the market whenever they believe that a correction is overdue, or if they think a commodity like corn or oil or gold is overvalued. So something to keep in mind is this: when you purchase a stock or you go long, you create an environment of risk because the investment, it could go down in value, right? Now, if you short something, you're doing the exact same thing because the investment itself, you're shorting it, right? It could rise in value, which would in turn decrease the value of the short investment because the ultimate goal of shorting something is to make money as it falls in price. So let's take a look at an example of long and short. So Pat buys one share of company ABC stock at $100 a share. And she decides once the price reaches $115 per share that she's going to take her gain and get out, right? Pat would, of course, made a 15% return on her portfolio. Now, on the other side of this, Pat wants to short company ABC because she believes that it's going to go down in value. So she again purchases company ABC at $100 a share, and the price goes down to $85 a share. Now on this side, Pat would have again made a 15% return. So she again decides that she wants to take her gain and get out. So this is really a simple example of how an investor can go long or short on an investment. Now, going long or short on equities or any other investment, it really requires skill, investment savvy, and a fundamental understanding of how the stock market and its overall landscape operates. So if you would like more information on long and short investments, please give our office a call or feel free to check us out on the website.
Remember when life was simpler? When things didn't move quite so fast and the world didn't seem so complex? Remember that? We do. And as the world around us has continued to speed up, becoming more complicated and still a bit uncertain, we have managed to keep things simple, providing sound, easy-to-understand financial advice and customized roadmaps for the road ahead, from tax reduction strategies, investment advice, and guaranteed retirement income you cannot outlive, backed by the claims-paying ability of insurance companies. We can be your single point of contact, a single call, a voice you recognize well, and a partner who can be by your side for the entire journey. We can't stop the world around us, but we can help ensure you're prepared for what's to come. To schedule a no-obligation meeting, simply contact us today.
And when you take a look at annuities, there are a lot of myths and misconceptions about how they work. And those that know us here on the show know that we're not real big fans of variable annuities. Some of you out there might already have some. I know sometimes advisors may recommend them, and that could possibly be okay. We're just not big fans of them. What we prefer, if you're going to have money invested in an annuity, and that's not always appropriate, but if you are, I think it makes more sense to invest in the index annuity as opposed to the variable annuity. They both might have a time and a place where they're appropriate. Just as a firm, we prefer one over the other. And it really comes into a couple of different reasons as to why. So let me spend a few moments explaining what the differences are on the two different types of accounts. So the first category to consider or take a look at are going to be the fees. So if we take a look at a variable annuity, one of the reasons why we're not big fans of them is because of their fee structure. It's not uncommon obviously, for us to see fees on the variable annuity that range somewhere between 2 and 6% per year. I've been at this since 1997. I've actually seen a couple of times where individuals had fees on their variable annuity as high as 8% per year, not a one-time fee, but an annual fee. Fortunately, that's rare. It's usually somewhere between 2 and 6%. On average, what we see in our office is just under 5% per year. So to put that into perspective, let's say we have $100,000 in a variable annuity. If you're paying an average fee of about 5%, that means that you're going to lose $5,000 per year for them to manage it for you. Over a 10-year time period, you could lose as much as $50,000 in fees on a $100,000 investment. That gets very, very costly. And a lot of times we'll meet with individuals where they may have hundreds of thousands of dollars invested in variable annuities. Obviously, the fees have a dramatic impact over time. Now, with the index annuity, typically, we're going to have no fees because what's happening is we're putting our money on deposit with the company. They're going to make money on the money, a lot like how a bank makes money on a CD, so there's typically not any fees. There are a few of them out there that may have some fees, though, and they typically, though, are going to be below 1% per year. So certainly not very costly. If we want to take a look at basically the risk of the two different investments, well, the variable annuity, your money is at risk. It's invested in the market. So you're using different mutual funds within a variable annuity. If the market goes up, you'll possibly win big. But if the market goes down, you could possibly lose big as well. So that money is at risk. And I know there are some variable annuities out there where individuals will think, well, Matt, no, I've got some sort of a guarantee. That's only typically if you annuitize the account and turn it into a monthly income. If you want your lump sum of money, it's at risk in the market. On the index annuity, the money over here is safe. Okay, the principal and your growth is safe from market downturns. So if the market were to drop by a large percentage, probably not going to make anything, but more importantly, you're not going to lose anything. Okay, so that money is going to be safe. The other thing to take into consideration as well, what are the returns? And this is, again, another area where there's a big difference between the two different types of accounts. Again, very, very different. On a variable annuity, again, like I just said, we may be able to win big in any given year, or we may lose big in any given year. So a variable annuity in any given year could maybe earn as much as 25% if we have a great year in the market. If we have a bad year in the market, we could possibly lose as much as 25%. Now, sometimes you may make more or lose more than that, but that's pretty much the range. So pretty wide range. On the index annuity, again, because of the safety features on the account, the worst thing that's going to happen is that we can get a 0% return for the year. Now, in years where the market loses 10 or 15 or 25%, those are years where a lot of times I'll say zero is a hero because when the market drops, people don't get upset about the fact that they're not making a lot on their investment account in this type of a strategy because more importantly, they're not losing. They don't then have a big hole that they have to dig their way out of. Now, the same is true, so on the low end, we can't lose anything, but one of the differences is on the high end, if we're real lucky, we might maybe earn as much as about 15% per year. In the good years, we'll probably earn a little less than that, but when things go perfect, we can maybe earn as much as 15%. So it's not as wide of a range as the variable annuity. It's a much shorter range. And I think, again, it's really more appropriate, the index annuity, for those that are retired or soon to be retired, meaning if you're within about 10 years of retirement. In my opinion, and everybody's opinions can be different about this, but in my opinion, I think the index annuity is a little more appropriate than the variable annuity. Maybe where this could fit is if somebody has 15 or 20 or 25 years to go to retirement, maybe this would be okay because maybe if returns are really good, it'll offset the fees. I don't personally think that will happen, but maybe it could happen. But again, if you're closer into retirement, I really think that the index annuity is a little more appropriate. Now, sometimes when individuals have variable annuities, they find out how high the fees are. They feel like they're stuck. The good thing I can say about a variable annuity is probably about 9 times out of 10, you can fix these accounts and reduce this cost without having to incur any penalties. Okay, so there are ways around the surrender charges or the penalties sometimes. Cannot do it 100% of the time, but probably about 9 times out of 10, you can fix those accounts. You are not stuck paying those high fees. So if you have a variable annuity or if you're considering a variable annuity or maybe even an index annuity and you have questions, feel free to give us a call at the office. We can give you a second opinion, see if there's a way to reduce the cost if you already have one, and then compare a variable annuity to an index annuity if you're trying to consider either one. So feel free to call the office. We'd love to help you out with it.
You're on the back nine heading for the clubhouse. Your dreams of spending time with family and enjoying retirement are just within reach. What happens if you end up in the rough? In these uncertain times, it's crucial to be prepared with sound advice. Strategic Wealth Designers is one of Kentucky's premier retirement planning specialists. For a complimentary consultation, call 1-502-653-6080. Strategic Wealth Designers. Plan to retire well.